Hello everybody, Karan here. Today we'll be looking at another fixed income investment instrument, that is bonds or debentures, NCDs, whatever you call it. Bonds are a type of loan that you give to a bank or government or whoever is the bond issuer. So just like you borrow from bank and you pay interest, similarly, you can lend to corporates and government, and in return they pay you regular interest that is called coupon. Let's go ahead. Why to invest in bond? So the advantages of investing in bond are it has got negative or lower correlation with equities. Government bonds usually have negative correlation, and corporate bonds have lower correlation with equities. It gives you a periodic income. You have option of selecting quarterly coupon, semi-annual, annual, or directly at the maturity. It is less volatile asset, so you're not going to see a volatile movement like stocks into it. It gives you more return than fixed deposit. Generally, it gives you more return than fixed deposit, but then again, it depends on the instrument. It depends on at what price you are getting it. Disadvantages are that it's illiquid. The bond market in India is particularly quite illiquid. Uh, especially for the corporate bonds, you don't really get good quality corporate bonds. I mean, you cannot just buy it like stocks. Usually, they are traded in large ticket size and they are traded in the OTC markets. So it's quite difficult to get your hand on good quality corporate bonds. They are very much sensitive to interest rate and inflation. So if interest rate goes up or inflation goes up, your bonds will definitely go down. Uh, and it's disadvantage instrument. So you pay 30% tax on the accrued interest, just like fixed deposit. Let's go to the type of bonds. So there are corporate bonds issued by corporates, or it can be banks, it can be NBFCs or other any other corporate. There are government bonds and treasury T-bills. T-bills are usually less than a year. It's like 90 days, 180 days. GSEC is the sovereign government bond guaranteed by government. Then there is pseudo government bond, is like bonds issued by public sector units by REC, NHAI, infra bonds like NHAI, or bonds like NTPC. These are all pseudo government bonds. So they are issued by government owned entities. So they are more safer compared to corporate bonds. And then there are bonds issued by state and municipal corporations. Then there is a special category called capital gain bonds, which we'll be seeing towards the end of the presentation. And there is a sovereign gold bonds that we would take in a completely another presentation, which would be on gold. So I'm leaving aside that for now. And then bonds can be classified into two types. One is coupon bond and one is zero coupon bond. So I'll show you the difference between both. For a coupon bond, if you it's like you buy the bond at 100 rupees, so you're paying 100 rupees today. If you buy a 4-year bond, every year you'll be getting 10, 10, 10, assuming that 10 is the coupon rate. And on the fourth year, you would be getting 110. So you'll be getting your principal back, and you'll be getting your getting that interest rate or interest of 10 rupees. That's how a coupon bond works. Uh, it's more like fixed deposit with annual payout, annual interest payout. A zero coupon bond, on the other hand, is it would on the fourth year it would pay you 100 rupees, and you can buy it at 68 right now. So what it does is it reinvests your investment. So it's again like fixed deposit where you just reinvest your interest. So you buy it at 68 and you directly get 100 rupees at the end of fourth year. So your interest gets accumulated there. So these are the basic two types of bonds. What are the risks in investing into bond? So in investing into bond, there is the default risk, which everyone knows about, that if the issuer defaults, your money is gone basically. The recent example comes to my mind is DHFL. So if the issuer defaults, your money is gone. Then there is interest rate risk, which not people really think about. So if you are buying a long term bond, if you're buying a 20-year bond or something, and if interest rates go up significantly and you try to sell that bond into the secondary markets, you will be facing significant capital losses. So interest rate is also a major risk type. Interest rate risk is more prominent into government securities because they don't usually have default risk, and default risk is more prominent into corporate bond. Corporate bond has usually both. They have got interest rate risk also, and they've got default risk also. Interest rate risk can very much be mitigated if you're holding the bond till maturity. So this impacts only if you're trying to selling the bond in between. How can you invest into bonds? So you can apply for the new issue through your broker. Usually, just like IPOs, you can apply for the new issue of bonds. You can buy it into the secondary markets, or and for GSEC, for government bonds, you can invest through GoBid app by NSE. You can use Zerodha coin, or if your broker allows, you can buy it from your broker. Let's look at how we can buy them. So for if you want to buy a bond in live markets, you can check which bonds are available for sale on NSE website. These are the bonds that are available for sale. This is the coupon rate. This is the interest, periodic interest that you will be getting, but this is not the actual return you will be getting. So we will be seeing how do you calculate the actual return. Then for as I said, for GSEC and uh, T-bills, you can invest it via Zerodha. So I've opened up this page on Zerodha. Currently, there state development loans. So these are like state bonds. These are on offer. These are the kind of yield you'll be getting. This is the interest rate that you'll be getting, and this is the yield. Yield is the actual return that you're going to get. You can So this is another. So I opened it up for on HDFC Securities. They also offer uh, to buy they also offer a platform to buy GSEC. GSEC bonds are usually auctioned. You cannot bid your price. The prices are bidded by institutions, and you just accept the price whatever is been bidded. Uh, you can see when the next bidding is going to happen. I've just opened up the page already for you all. Uh, Government bonds are going to be there on auction on May 24th to 28th, then 31st to 4th June. So these are the bonds. These are the bonds that would be issued: 5-year bond, 14-year bond, 30-year bond, and there is, you can also check T-bills when they would be auction. They would be available for auction. So usually, yeah, T-bills is for less than a year, and these are the auction dates. So you can just go to this platform by Zerodha. You can go to coin, or you can go to GoBid. You can place your bid for how much ever quantity you want. T-bills are zero coupon bonds, uh, just like we saw over here. So a T-bill would generally, since it's less than a year, a T-bill would generally be available to buy at what? We'll just take an example over here to show you how do you even calculate. So you will have to use Excel extensively if you want to invest into bond. You will have to use present value is one function you will have to use, future value is another function you'll have to use, and rate is one function that you will have to use. So let's take this example of zero coupon bond. You can find treasuries at approximately 3%. Your investment horizon might be, let's consider 180 days. I'm doing 360 because that's the general convention. You can do it by 365 also. This rate is 0. Just a minute, just a second. This also we are supposed to multiply by 180 into 360. So the 3% is the annual interest rate. You have to multiply it by 180 by 360 to get the interest rate for that 180 days. Your investment period is 180 by 360, and you are not going to get any coupon. It's a zero coupon bond. So coupon is PMT is 0, and future value is usually 10,000. It's 1,000, and you can bid into multiples of 10 for T-bills. So usually you will get that bond at 992. So 9,900 is what would be the minimum ticket size, because you can usually bid for it into into units of uh, 10. So this is what you'll be paying, and after 180 days you will be getting 10,000. So that's how T-bills work. GSEC is just like any other bond. You invest, you keep on getting coupons, and at the last you'll get the principal and coupon both. Let's go ahead.